Hello, everyone, and welcome. Look, if you're trying to build real wealth today, you are probably feeling completely overwhelmed. And honestly, it makes sense. Never before have we had so much access to financial tools, yet never before has the landscape been so crowded with noise, hype, and hidden traps. I am so glad you're here because today we're going to cut right through all that noise. Think of this explainer as a private consultation. We're going to break down the latest modern financial shortcuts, examine the actual data behind them, and build a structured, no-nonsense playbook for your money. Okay, let's dive right into this. Would you trust AI with your financial data or TikTok with your tax return? It's a serious question. We all carry these supercomputers in our pockets, and every single day we are bombarded with promises of effortless wealth. An AI chatbot claiming it can manage your entire retirement, or a social media influencer swearing they can 10x your tax return in 6 months. It is incredibly tempting to look for a cheat code for the stock market, but taking these shortcuts without actually understanding the mechanics behind them, well, that is one of the absolute easiest ways to derail your financial future. So here is our meeting itinerary for today. First, navigating modern market noise. 2, the truth about AI advisors. 3, social media finance traps. 4, avoiding headline panic. And 5, your actionable investing blueprint. Let's get started. Section 1, navigating modern market noise, cutting through the chaos. Right now, we're facing what I like to call the modern investor's dilemma. On one hand, we have these shiny, incredibly accessible new tools. We're talking AI chatbots ready to build your financial plan, social media platforms hyping up copy trading, and prediction markets that literally let you bet on anything. But then, on the other hand, we have these smoky, downright scary macroeconomic realities. Geopolitical conflicts disrupting global trade, unpredictable tariff changes, and rising defaults in the somewhat opaque private credit market. The real danger here is that those shiny new tools often lack the traditional oversight required to actually protect everyday retail investors from the very real macroeconomic risks lurking in the background. Section 2, the truth about AI advisors, speed versus security. With tech giants piloting specific finance windows and brokerages rolling out AI trading agents, we really need to weigh the pros and cons. Now, AI advisors are undeniably accessible. You can get a baseline financial review at 2 a.m. on a Sunday, totally judgment-free. It's honestly a lot like Googling your medical symptoms before seeing a doctor. It's fast, and let's face it, people are often way more honest with a computer about their credit card debt than they are with a human. But the cons are massive. AI models are prone to hallucinations. They will sometimes confidently present terrible math or completely inaccurate information as absolute gospel. And crucially, you have to worry about data privacy when you're linking your bank accounts, not to mention the complete lack of any fiduciary duty. And that brings us to a huge legal gap. Fiduciary duty is the legal obligation to act entirely in a client's best interest. AI models simply do not have this. For example, some AI chatbots have already announced paid partnerships with tax software companies. If an AI is getting paid to direct you to a specific financial product, it is not prioritizing your best interest. It is operating on a conflict of interest, and right now, users have almost zero legal protection against this. We have to remember this fundamental truth. Large language models are language prediction models. They are not judgment models. They aren't in the background conducting deep, sophisticated investment research. They are essentially just piecing together a string of words that sounds like a plausible response based on whatever data they were trained on. They predict text, not financial outcomes. So always, always verify their math, and please never rely on them for high-stakes individual stock picks. Section 3, social media finance traps, the illusion of the cheat code. If you spend even 5 minutes on finance TikTok, you're going to see claims exactly like this one. Just turn your little tax return into $30,000. All you gotta do is buy tech and AI. It is purely an emotional appeal. And it's frustrating because it often targets vulnerable people or folks living paycheck to paycheck, selling this get-rich-quick fantasy that is completely and mathematically detached from reality. Let's just firmly shatter that illusion right now. The expectation they're selling you is a rocket ship, this idea that you can 10x your money in half a year. But the objective, historical reality, it looks a lot more like a slow-growing, deep-rooted tree. Even the high-flying tech sector of the S&P 500, which has been one of the absolute best-performing sectors recently, historically averages roughly a 20% annual return over a 5-year period. Expecting massive, instantaneous wealth just pushes everyday investors to take on catastrophic risks when their portfolio inevitably doesn't 10x in a few months. So let's break down the actual mechanics behind these so-called cheat codes. Prediction markets, where you bet on news events, are essentially binary casinos. You've got a capped upside and a 100% downside. Then there's copy trading. It sounds amazing, right? Just mirror a successful trader. But in thin markets, the price actually moves before your order fills, which means you end up buying higher and selling lower than the person you're trying to copy. And prop trading challenges? Well, these firms charge you a strict qualifier fee to trade their money. The open secret in the industry is that the vast majority of their revenue comes from users failing those exact qualifiers and losing their entry fees. If you need hard proof, look at this. Independent blockchain analysis of the massive prediction market Polymarket revealed that 84% of their users realize losses. 84%. These are not long-term investment vehicles. They are negative return gambles disguised as financial innovation. The house, or in this case, the platform, almost always wins. Section 4. Avoiding headline panic. Staying calm in the macro storm. Now, this timeline brilliantly illustrates a massive trap that retail investors fall into. We call it the headline reaction cycle. Breaking news hits, maybe it's a massive new tariff or a geopolitical conflict. Day one brings shock and volatility. But within a week, or honestly, often within minutes, sophisticated trading algorithms have completely priced that news into the market. If you are panic selling or trying to trade the news a week later, you are already way too late. By year one, the market is driven by long-term economic fundamentals, not that single day's scary headline. Take geopolitical conflict, for example. When tensions rise in the Middle East, specifically around the Strait of Hormuz, which handles roughly 20% of global crude oil transit, we immediately see panic and commodity price spikes. It becomes incredibly tempting to start trading oil stocks based on those headlines. But reacting to this noise ignores the fact that supply chains actually adapt and alternative routes exist. Trying to time global catastrophes is just a losing strategy. We see a very similar panic with economic data. Right now, there is some totally valid fear regarding the private credit market, which is this opaque sector that kind of acts like a shadow banking system. Corporate default rates in this space have actually crept up from an 8.1% average in 2024 to a recent high of 9.2%. And yeah, it's concerning, absolutely. But completely liquidating your carefully diversified portfolio because you're trying to perfectly time a systemic debt shift, that is a massive gamble, and it's one that retail investors almost never get right. So here is the trusted advisor's perspective, loud and clear. Trading on headlines means you are competing against nanosecond computer algorithms, massive financial institutions, and quite frankly, insiders. You do not have an informational edge. You simply cannot beat the market by panic selling the second you see a scary notification pop up on your phone. Section 5. Your actionable investing blueprint, the trusted advisor's guide. Let's synthesize all of this complex landscape down into 4 simple, actionable rules. Step 1. If you are going to use AI to get a financial baseline, strictly verify its outputs and double-check its math. Step 2. Aggressively ignore social media hype. I promise you, there are no cheat codes. Step 3, do not trade the daily news because you will lose to the algorithms. And step 4, stick to long-term diversified fundamentals. A little bit of consistent investing over a long period of time completely crushes gambling for a massive overnight return. Keep this piece of wisdom in mind as you build your own portfolio. The truly wealthy, they don't chase flashy short-term trends or binary gambles. They deploy their capital into diversified, productive assets. They let time, compound interest, and business fundamentals do all the heavy lifting. Essentially, they let their money work much, much harder than they do. I want to leave you with this provocative thought to chew on today. Take a good, honest look at your own portfolio and your daily financial habits. Are you genuinely building a durable financial plan for the long run, or are you just rolling the dice on today's loudest noise? Stay disciplined out there and seek out a true fiduciary professional if you ever need tailored advice. If you found this consultation valuable, please make sure to subscribe so you don't miss our next explainer. Thanks so much for joining me, and stay focused out there.